Hey everyone, welcome back to the channel, your number one source for income-oriented investing. It's always an exciting day when one of my personal favorite high-yield income-oriented covered call ETF fund managers in Canada, Hamilton ETFs, launches not one, but two brand new covered call ETFs that have yields way north of 10%. So in today's video, we will quickly review the two ETFs together. The first one is the Hamilton Technology Yield Maximizer ETF, stock symbol is QMAX, with an initial target yield of over 13%. And the second ETF is SMAX, that is the stock symbol. It is the Hamilton US Equity Yield Maximizer ETF with an initial target yield of over 12%. So very exciting, especially SMAX in my opinion, because this is their first broad-based ETF, part of their yield maximizer series. The other ones, including QMAX, a new one, is really sector focused. So looks like they're expanding the lineup, and that's because they have now Nick Picard, one of the best options specialists in Canada. And what we're going to do in this video is quickly review these two ETFs, and then we will talk to the boys again, Patrick Somerville and Nick Picard, of course, from Hamilton ETFs, and I'll ask them questions about these two ETFs. And I do have a lot of questions about them. So for example, for QMAX, there's a lot of technology covered call ETFs in Canada. Why should investors choose QMAX instead of the competition? When it comes to SMAX, they're doing a stock selection. There's 25 stocks in there, like we will see in a second. So why did they do this instead of just doing an S&P 500 with covered calls? We'll ask them that. And most excitedly and more importantly, what's going to happen to HYLD now? They're very popular all-in-one leverage covered call ETF. Is there going to be drastic changes now that they are just launching these two in-house US or American specific covered call ETFs? Let's find out together right now. All right, everyone, let's start with QMAX, the technology one. So just like the name says, this is going to be technology focused. If we look up the objective, QMAX is designed for attractive monthly income. So when I see income first, you know that it's really income focused, while providing exposure to a portfolio of primarily large cap US technology equity securities. To reduce volatility and augment dividend income, QMAX will employ an active covered call strategy. No leverage in this one, so good fit for investors who want high monthly income. Of course, tax efficient distributions, because these distributions are primarily going to be capital gains, and a very attractive initial target yield of 13% plus. So let's look at the stock selection first. This is always what we want to check. Look at the stocks inside the ETF. So you have an equal weighted. So you could see here, the weighting is all 6.7% of 15 big, large cap technology companies that you will probably recognize all of them. Apple, Microsoft is there, Intuit, Adobe, so a lot of some software. You also have, of course, Google and Amazon. Not only that, you also have the chip makers, right? You have AMD, you have Nvidia, you have more the network equipment style stuff like Broadcom and Qualcomm. You also have Tesla and Netflix, which I found very interesting. Typically, you don't see those two names in technology covered call ETFs. I found that was interesting. So listen, everyone, this is 15 very important, big cap, humongous, technology focused companies. And just like the other yield maximizer ETFs, the distributions are going to be monthly. The management fee is 65 basis points. I just noticed this now. There's actually a low to medium rating instead of your typical medium. And that's really because these are quality companies, and there's a covered call strategy as well. So all technology. If we look at the covered call strategy, unlike the UMAX and HMAX, they are writing options on approximately 30% of the portfolio, not 50%. And that makes sense because these stocks are very, very liquid in terms of options, are a little bit more volatile. So they probably, to get 13% yield, they don't have to write on 50%. They could write on 30%, but they are still writing at the money options, which are very, very high and very lucrative. So with this ETF, you practically have, at a bare bone minimum, 70%, or approximately rather, 70% growth potential, because they're only writing on 30% of the portfolio. So very, very interesting here. QMAX, another covered call technology ETF, gonna be the highest yielding one. I see that here, 13% plus. All the other ones like TXF from CI and HTA from Harvest have a little bit lower yield. So definitely gonna be your highest yielding one here. And we'll ask Hamilton all about it later when we talk to Patrick and Nick. Now, the next one is SMAX. This one is actually their first more broad-based covered call ETF in their lineup of yield maximizers ETF, because it's the US equity yield maximizer ETF, right? So this one is a little bit more broad-based. So if we look at the objectives, designed to, from attractive monthly income, of course, while providing exposure to a portfolio of primarily large cap US equity sectors. And you see in the highlights here, it's blue chip equity stocks, so very, high quality stocks with a sector mix similar to the S&P 500. So what's inside SMAX? This is very interesting. So instead of going with, an S&P 500 and just writing calls on the S&P 500, just like QMAX, they decided to actually do an actively managed portfolio of stocks. But instead of 15 stocks like QMAX, it's 25 stocks. There's a lot more stocks, equal weighted once again, not market cap weighted, which means that all of them have the same percentage, right? Apple and Microsoft are not going to have a huge percentage like in the indexes. That's market cap weighted. This is equal weighted. I found that very interesting. We'll ask them about it and why they decided to do that. So if you scroll down, all of the stocks, you should recognize them, right? So it's not just technology. You have the sector mix here. So of course, the general sector mix of the US economy or the US stock market is primarily technology. You see that here, 32%. But you have a little bit of everything, really kind of like the leaders in the US. You have Burke, which is Warren Buffett's company. Of course, you still have Cisco and Google and Adobe and Apple and Amazon and Broadcom, but you also have other things like Home Depot, Honeywell, which is industrial. You'll see some financials and healthcare as well. So Johnson & Johnson, JP Morgan, Lilly, some energy, even some real estate. You have a REIT here, Procter & Gamble, Pepsi, so Tesla's there again, ExxonMobil. So a really nice mix, really like the name says, or like we saw in the highlights, that's broadly, the sector mix is broadly similar to the S&P 500. So this is their first more broad-based yield maximizer ETF, because QMAX and HMAX and UMAX are really sector specific, but this one is more broad in terms of nature. So very, very interesting. Cover call strategy, by the way, is the same. The options are only on 30% of the holdings, or 30% of the portfolio instead of 50% like HMAX and UMAX, but also at the money calls. And the target yield is 1% less than QMAX at 12% plus here, which is very, very attractive. So this is really a broad-based US covered call ETF, but it's different from an index-based one because you have really 25 companies here, all equal weighted, and we'll ask them why they decided to do that. And also, you're probably wondering the same thing I'm wondering. They came out with SMAX, they came out with QMAX. What's going to happen to HYLD? So HYLD is one of my personal favorite covered call ETFs that combines a bunch of covered call ETFs, focusing really on America, like the name says, right? US covered call ETF that uses 25% leverage. You got a lot of external ETFs here that really capture the overall US market, like JEPI, JEPQ, et cetera, et cetera. So what's going to happen to HYLD? Are changes going to be coming? Are they going to, add SMAX to it and reduce the fees of HYLD and probably increase the yield as well? Very, very exciting stuff. Let's ask Patrick and Nick all about these questions right now. All right, everyone. Thanks so much for joining and coming back to the channel. It's been a while, right, guys? So I'm joined by Patrick Somerville, Nick Picard from Hamilton ETFs. How you doing, guys? Thanks so much for coming back so soon.
We're doing great. Nice to see you as always. Thank you for having us.
Very excited. You guys actually have two important launches coming up. And I'm very excited. I mean, QMAX, of course, we're talking about QMAX, the Hamilton Technology Yield Maximizer ETF. We'll talk about that one first. And then there's also the Hamilton US Equity Yield Maximizer ETF, SMAX, as well, launching. They're launching on the same day, right? Or together?
Correct. Yeah, they'll begin trading on October 26th. So next
Awesome.
Thursday.
So let's start with QMAX. So QMAX is obviously tech focused, right? There's a lot of technology covered call ETF. So let's talk about the stock selection because I'm very curious about that. So you guys decided to go with an actively managed portfolio. So it's not like there's a NASDAQ index or anything like that. You've chosen 15 companies And another thing I noticed is that it seems to be equal weighted, not index based. So, Apple, Microsoft make up such a huge part of the NASDAQ, but it seems to be all, everything's at 6.7%. So give me your thought process why you guys decided to, number one, do stock picking and why equal weight. Maybe we'll start with that.
Yeah, thanks, Adriano. And I think there were a couple reasons. First of all, we wanted to build a portfolio that was really focused on large cap technology names, and so that's why we constructed the portfolio this way. We wanted something that really looked at the technology sector, and by looking at the top market cap names, we get a lot of liquidity on the option side through our covered call strategy. But then, of course, as you know, when you're starting to look at various weighting schemes, you could go market cap or equal weighted or whatnot. And the market cap weighted portfolio really is so tilted towards the big names such as Apple and Microsoft. We wanted more diversification. We wanted more opportunity for some of the smaller names to contribute to the returns. And it works also well from a covered call perspective because some of the maybe not as large names actually have higher volatility that we can use to get higher covered call premiums. Despite that, all the 15 names in the portfolio are very well-known names that everyone would know, from Apple to Microsoft, but as well like a lot of the big semiconductor names as well.
Yeah.
We have Tesla in there as well. So we have a broad mix of large cap tech names. And for investors that want exposure to the tech sector while still getting that extra yield and that extra income, we thought this was a good portfolio.
Yeah, for sure. I mean, you have not just, software companies, you also have the chip makers, like you said. We're looking at the 15 stocks right here. So you do have AMD, you do have Nvidia, Qualcomm, Broadcom, so some chip network providers. You also have software like Adobe and Intuit. I was just curious, Netflix and Tesla, these are typically not in a typical covered call technology ETF. Is really the reason why you put them in for, like you said, liquidity, good for the options?
Yeah, and I mean, I think depending on how you look at those names, they're definitely technology-like. I mean, they're based on technology platforms. They're the
Yeah.
future in their own sectors. So I think it's easy to argue that despite the fact that they might not be technically, in one sector or another, people view them as technology names overall.
Yeah, and they're pretty high up on the Nasdaq too. I mean, they're part of the
Exactly.
Nasdaq. So
Exactly. And our focus was definitely on the large cap names, of the Nasdaq exchange.
okay, fair enough. Let's talk about the covered call strategy. So these two are now part of your ever growing phenomenal lineup of yield maximizer ETFs. And one thing I noticed right off the bat is that it says right there on your website, QMAX writes options on approximately 30% of the portfolio, where your other ones were on approximately 50% of the portfolio. So much less covered call writing in terms of percentage. It does still say at the money options. So is this because these stocks are just so, they're tech stocks, so they're a bit more volatile that you really don't have to do it on 50% to get such a big yield? You could do it on 30. So run me through the cover call strategy.
Yeah, exactly. And we wanted to take an approach that was an income first approach. So targeting, a mid-teen yield, which is what we're, targeting here with this ETF. But as you said, the volatility environment that for technology names is just quite a bit higher than what you would see in the financial sector with HMAX or in the utility sectors for UMAX. And
Right.
so we don't have to write as much of the portfolio to get the same amount of premium yield. Furthermore, with the tech sector, of course, it can go on pretty big moves. And generally, investors who do invest in technology names do want to capture some more of that growth because it is more of a growth sector than the financials or the utilities. And so by writing a little bit less, we're going to be able to capture more of that growth. That being said, however, relative to other technology covered call ETFs, we are still focused more on the income aspect, and that's what we try to do for our investors.
Okay, fair enough. That makes sense to me. And what are you guys going to be writing cover calls on? The individual stocks in the portfolio? This, I'm assuming this is an actively managed approach. Are you going to be writing options on the Nasdaq, on the NDX, or just on the stocks?
Yeah, no, that's a good question. We want to focus just on our names
Okay.
because we only have 15 names in the portfolio. there's going to be a pretty high correlation probably with the index, but it's not going to be perfect. And so we don't want to be writing index options. Looking at the single names, we actually are going to get a higher amount of premium by looking at the single name options. And it also allows us to fine tune when we write the options on each individual name. And we can use our active covered call strategy to get the income on a monthly basis.
Okay, perfect. So last question about QMAX, and this is an important one. So as you guys know, you've been monitoring the covered call space in Canada. There's a lot of competition when it comes to technology covered call ETFs. I mean, you have TXF, you have HTA, you have TLF, ZWT, you have even Evolve came out with QQQY. So my question is, why should investors consider QMAX over these? What would you say sets it apart or is different from these?
Well, he's sitting right here. There's only one Nick Picard, but
that's true.
You're 100% right. There's lots of choice in the marketplace right now for all covered call ETFs. I think what's interesting about QMAX relative to the competitors that are out there in Canada, at least, is QMAX has a higher yield. That's the first point.
Yeah.
But we're able to do that, as Nick talked about earlier, with a coverage ratio that we think is still offers a fair amount of growth potential to the underlying stocks as well. So I think that's a very good balance. But to your audience and for income seekers, this would have a higher yield than the competitors, I would say. And then also, as Nick talked about earlier, it's it's pure technology. So we're stripping out names from the NASDAQ like Pepsi, for example, things like that. So a pure tech and a higher yield.
Okay, perfect. Let's move on to SMAX. I'm very excited about this one because it's really more of a broad-based one. And I have to admit myself, I was actually pretty surprised to see that, again, just like QMAX, you're selecting stocks. So it is 25 stocks. It's a little bit more. So let's talk about SMAX now, the Hamilton US Equity Yield Maximizer ETF. So again, why not, I'm just curious, why not just do an S&P 500, write calls on the S&P 500? Why did you guys decide to select 25 stocks instead on this more broad-based fund?
Yeah, why don't I start there, and then maybe you can give us some color as to why we wouldn't do the index. Really what we wanted to have here was almost like a US equity leaders ETF, where we're in the names that people are familiar with, they know very well, essentially offering them the sector leaders of the S&P 500 in a bit more of a much more concentrated portfolio, I would say. And then Nick, maybe you want to highlight why we wouldn't do the alternative, which is write options on the index.
Well, yeah, sure. Well, there's a couple. First of all, just on owning like 500 names, it's not very practical from a options writing perspective. That would be a lot of trading costs, especially on the smaller names and whatnot. And so by focusing on the top 25 names, we get a very good, highly correlated basket to large cap US names, without having to own all 500. And of course, all these names have extremely liquid options markets, which makes our cover call strategies so much easier with lower trading costs. And finally, why wouldn't we write on index options? For the same reason that we wouldn't do it with QMAX. This basket doesn't necessarily have to move exactly along with the S&P 500, although it'll likely be very close. But also with index options, you're not going to be able to get as much cover call premium as if you're looking at each individual names and monetizing that volatility.
Yeah. Okay, fair enough. And again, this is equal weighted again. So 25 names, equal weighted, 4% each. Very interesting. Very tech focused because the US is very tech focused, but this is really diversified here. I mean, you have things like Berkshire, Home Depot, Honeywell. I pretty much, you would recognize all of them, right? Lilly, JP Morgan, Pepsi. So really, really nice mix that your ExxonMobil is here. So you're kind of having the top 25 big players in the S&P 500. Very, very interesting. Cover call strategy, same thing as QMAX, right? As far as I saw, at the money calls on approximately 30% of the portfolio, not 50%. Is it the same reason? These are big liquid stocks to write options on? That's
exactly the same. Exactly the same thing, same reason. And one additional thing I'm going to point out about the portfolio is that even though it's equal weighted, we do have more names in the sectors that are more representative of the US large cap market. Like the S&P 500, in the sense that we're going to have more technology names, and fewer, financial names, for example. So even though it's equal weighted, we do have more weightings in certain sectors. But on the covered call aspect of things, it's still our same tried and true strategy, which is maximizing the income on the options by looking at the money options. And again, because these names are a little bit more volatile than what you might have in a less volatile sector, we only need to write 30% there as well.
Okay. And are these mostly monthly call options? I know there's weekly options as well. Are you doing a combination, or you're just sticking with monthly options on these?
Yeah, no, that's a good question, and it is an active strategy. So for the
Okay.
most part, we are focused on kind of the shorter term option expiries, 1 month. But there will be times where we'll do weeklies, especially around big event dates. And I'm thinking of earnings dates, for example, on each of the individual names where you might want to avoid a pitfall around earnings or dividends. So there's always the flexibility to change the expiries a little bit and
Okay.
diversify the strikes. And that's really one thing that I think we do very well at Hamilton is not just write all the options 1 month out just on one day. It's to diversify in terms of our approach when we write, and we can add value that way.
Yeah, that honestly, that's exactly what I want to hear from my cover call manager. I always prefer an active approach, that they're looking and not just doing a rinse and repeat. So that gives me comfort for sure. Last question about these ETFs. What about the rebalancing? So they're both equal weighted. Are they going to be obviously that means if one stock just shoots to the moon and the others don't, it's going to start making a bigger percentage. Are you going to rebalance every quarter, or what's your plan for that?
Yeah, so the plan is to rebalance the portfolios twice a year to an equal weighted portfolio, and
Okay.
also we're also going to be looking at what are the large cap leaders, whether it's in the broad market or whether it's on the Nasdaq, and adjust the portfolio so that we're always going to try to be representative of the large cap names in the U.S. For SMAX, and on the large cap tech names for QMAX.
Okay, excellent. So let's talk about the distributions. People are always curious because high yield, they want to know how are these going to be taxed. So am I correct in saying, especially the QMAX and even SMAX, I mean, most of the stocks in there give no dividends. So it's not like there's going to be much, if at all, foreign income. Maybe SMAX a bit more because there's Microsoft and JP Morgan. But can you say like the biggest percentage is really going to be from the covered call options, which in Canada is capital gains? Is that correct?
Absolutely, that's correct, and
Okay.
and that's one of the big advantages
Yeah.
of using covered call ETFs in Canada is the fact that covered call premiums are treated as capital gains. In the case of our other covered call ETFs, which have a higher dividend component, there's going to be more of dividends and versus capital gains. In the case of QMAX and SMAX, we can expect more of the distribution is going to be around the cover call premiums, which is great for investors in terms of the income they receive.
Yeah, so mostly capital gains. Yeah, I understand what you mean. HMAX, UMAX, a lot of eligible dividends because a lot of those, well, actually all those stocks have really high dividends. So that's awesome. So I'm just curious. So you're growing your yield maximizer suite and lineup. Uh, as an income investor, I like them because they're, like you said in this interview and past interview, it's a yield first approach. I'm just curious, are you guys planning on launching leverage versions of them, or you're just pretty much staying away from the leverage because you think the yield is high enough? So I'm asking because there's providers now that are launching leverage versions of existing covered call
Mhm.
ETFs. So you actually have the option. Are you guys thinking about that at
Yeah,
all?
no,
Or?
we're not looking to do that. As you know, and a lot of your followers know, we have HDIV and HYLD, which
Yes.
offer other it's a de facto levered, covered call version of SMAX, for example. HYLD would be.
Yeah.
So we're happy with those. We want to have a diverse mix of ETFs at our company. Some investors don't like leverage. Some do, and so we want to offer a variety to different investors. And so, yeah, HYLD and HDIV are for those who are okay with the trade-offs that come with leverage, which is a bit more volatility, but a bit
Yeah.
more growth potential over time. And here on our Max suite, we're really focusing on the income investor. And to your point, we can achieve a very high yield without the leverage, but it also comes with its trade-offs, which is, you're capping your upside as versus what you get from HDIV and HYLD if the markets are doing well.
Okay, fair enough. And since you brought it up, Pat,
Yes.
HYLD and HDIV. So I know you can't answer this question directly, but it's probably the number one question my audience has been having. Do you think SMAX or QMAX, well, let me ask it this way, are they eligible contenders to be added to the HYLD ETF, which is, if you look at what HYLD is, it's really US focused covered call ETFs, and these two
Right.
are really US focused. So are they contenders to be added in there?
Absolutely. Yeah, it doesn't take Sherlock Holmes to figure out where these might end up. And so, what we're trying to achieve with HYLD, now that we have Nick on board with our company, having ETFs like QMAX and SMAX in HYLD, we're trying to bring in the overall cost to the fund. So reduce the fees that we're paying to third-party managers, number one.
Right.
Also, we'd like to, gradually bring up the dividend yield as well, which, our Max suite of ETFs do provide higher yields. And so, yeah, absolutely, they are eligible. And I would say stay tuned to our website for any changes.
Oh, we will. I definitely will. So yeah, like you said, it's not you don't need Sherlock Holmes to think about it. So all right, cool. So that's about it for the questions. I think I had one more, but I forgot about it. That's a shame. So I appreciate you guys coming on anytime to discuss your new products. Looking forward to the new launches as well. Oh yeah, I just remembered. So this is just more of a confirmation because I know what the answer is, but a lot of people think, let's say your own ETFs, because now you have, for example, UMAX and HMAX and HDIV. You're not double dipping on the fees, right? My question is around the fees. So if you're actually putting in your own ETF in another one, it's not like you're paying 65 to UMAX and 65 to HDIV, right? Just
Correct. Yeah.
clarify
So
that.
our focus here, and when for them to be included in an HO, we want to bring the overall management fees that we pay to third party managers down, right? And so yeah, there's no double dipping.
Okay.
And so we think that definitely warrants inclusion.
Just
And
wanted
also
to
the other thing that I
clarify.
didn't bring up too is some of the US listed ETFs in HO, right? There's withholding tax, right? Because they're US listed. So having a Canadian domiciled ETF helps with that as well, which is a considerable variable, I would say.
Yeah, 15% is pretty considerable because these are income-oriented ETFs. Most of the return is coming from the yield. So I would definitely say so. All right, so I think you've given us enough hints, and looking forward to it. These ETFs are going to be starting to trade on October the 26th. Looking forward to it. So guys, thanks so much for coming back, and we'll see you soon. Take care.
Thank you. Thanks for having us, and to your followers for tuning in. We appreciate it.
Thank you.
Appreciate it. Take care, guys. Thanks.